All right, we are live. Let's see, we got all the socials live. We got everything. We're ready to go. All right, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with Doug Hagren. Hey, Doug.
Good morning. Happy New Year to everybody, and post happy holidays, Merry Christmas. I guess you're still in the middle of Hanukkah for those for the Jewish faith out there. Apologies for the voice. It's a good time to have a little bit of a break, go on vacation, and get sick through most of it. Yippee! So
That's what we call a Christmas hangover, Doug.
I've got some mulled wine upstairs that we're kind of afraid to warm up and drink, but I haven't got into that yet. So I wish I could call it the Christmas hangover. Although I am a little behind, I'm still working on my whiskey advent calendar. So I might have to do a little medication today. You don't say, Kirk.
Oh, God. Good timing. All right. Well, gotta love that. 1 second.
I think this is what we call Kirk really, adding in the emotion, the drama, and summarizing everything I said in a few short words.
I think that's the first time that happened, drinking water on a podcast. Anyway, so happy Chris Kwanzaa, Merry Christmas, happy, excuse me, happy Hanukkah. Hope everyone had a good holiday. We're kind of in the tweener stage of the holidays, where it's not quite New Year's yet, but it's after Christmas, where people aren't really working very hard. So they call this the Santa Claus rally, which I will state that depending on who you talk to, the Santa Claus rally comes in different dates. My whole thing was, well, it's basically from Thanksgiving up until the end of the year. I think officially it is the week of Christmas up until the New Year. I don't really understand it. I think it's all bunk, but people think that there's something to it. I'm not sure about this year, because this year the market dropped, was it 3-4% right before? So maybe technically the market went up from after that drop until the end of the year, but realistically, if you look at a chart, it's nothing to sneeze at. So, but hopefully everyone celebrated Festivus. Festivus for the rest of us. Big fan of celebrating Festivus.
I went out and got a pole undecorated.
Yes. Did you have your feats of strength this year, Doug?
I feats of strength comes in many different forms, Kirk.
Well, we certainly had our errands of grievances when family gets together. That always happens. But yeah, I want to talk about a few things today, because we'll keep this relatively short. We're going to do our annual predictions next week. This week we're just going to go talk about a handful of stuff that I think is pretty interesting. For those of you who are looking to invest in the market in the Santa Claus rally, good luck. One of the challenges about this time of year is there's very little volume. All the professionals are on vacation. Pretty much all the traders are on vacation. So the people manning the trading desk are like the interns. So there's not a lot of, I would say, professionalism behind the last week or two of the year. So what's interesting is you can find some interesting stuff happening because of the low volume. If you're astute enough and hardworking enough, you could probably find some great deals. I remember, for example, I think it was probably like 10 years ago. I remember it was like a week left in the year, and I was just mucking around the office and was just looking at options. And I noticed that I think it was at the time ExxonMobil typically had a covered call yield of like 3% or something like this. And I noticed it went up to like 8.5%. It just bounced up to 8.5%. So I ended up selling a bunch of those. And then like 3 days later, went back to normal. And we just capitalized on a really big, quick win. And it was a lot of fun. Now, you do that once a year and you feel good, but it's once a year. What do you do the rest of the year? So my point is that I'm not sure if you'll. I know those deals are out there because when there's low volume, people play around with the prices, and you can kind of get away with some things because there's low volume. So you can find good deals out there, and maybe it's kind of like the traders trying to get their numbers looking really good in the last few weeks. But from my perspective, I'm not sure if it's really worth it because this time of year it's better to spend with family, to do things you enjoy. I spend this time of year doing I call it my best year ever planning. And I mentioned it last week where I go through my whole life and deconstruct it and decide what I'm going to do for the next year. And there's a bunch of good books that I've pulled from. I have my construct that I created, but I pulled from a bunch of books. Gary Keller wrote a good book called The One Thing. And there's a few others. But basically, the idea is to narrow down your focus for the year into a single word or a single focus. Like, for example, let's say you want to make an extra 50,000 this year, and that might be your goal, right? And you'd have to spend some time trying to decide, like, why do you want the 50,000? Like, is it just for just for social score, or is it going to accomplish something for you? If it is, what's that thing that's going to accomplish? So it's about figuring out what your focus should be and what's going to drive you and why you're doing these things. Anyway, it's a really important process. I do it every year. I'm right in the middle of it. I'm making great progress and I love it because it helps define and clarify what I need to be doing and gets rid of all the junk that's taken up my day. So highly recommend everyone spend some time to be reflective this time of year. I don't think you'll regret it. It's a very important process that I think everyone needs to go through. Anyway, as we kind of get in here, one quick thing I wanted to get into was I was reading a lot of year-end things, and some things came to mind. One of which is Jensen Huang, the CEO of NVIDIA, who obviously is a very wealthy man right now because of how well NVIDIA is doing. But every once in a while, I see this thing, and I really wanted to share it. And it's he spoke to students at Stanford University, and he said he wishes them all ample pain and suffering. Now, many of you look at that and be like, well, that's very insensitive. That's an insensitive thing to say to people. I wish you ample pain and suffering. But he goes on to explain it. And basically what he said, look, many of you have high expectations. You come from great schools. You've been successful, top of the class. Now you're in one of the finest institutions in the world. Clearly, you're able to manage success. However, many of you have high expectations and low resiliency, meaning that many of them are very smart and worked hard, but they haven't experienced a lot of failure. And resiliency is a crucial ingredient for success. It's not easily taught. And so what he basically went on to say is he uses this within his company, Pain and Suffering. It's not about negativity. It's about resilience with a sense of purpose, right? It defines greatness. Now, when I was growing up, we called this character. And when I went to school, I had a teacher and a coach who talked about having strong character. What do you do when times get tough? And if you watch the movie Wall Street, there was a line at the end where the old broker who'd been around forever was talking to Bud Fox right before he was going to get locked up. And he said, man stares into the abyss and finds there's nothing looking back. And at that point, man finds his character. And the point is when everything else is gone, what do you do? How do you act? That defines your character. And my coach defined it as character is how you act when things aren't going your way, right? How do you act when no one's looking? That's character. And while he uses pain and suffering, I think character is a similar word you can use there. Is how do you define yourself when things aren't going well? Now, the reason I'm bringing this up is everyone had a great year this year. And, if you lost money this year, I don't know what you would have been in, because I guess you probably would have been commodities. Commodities lost money this year. They didn't do very well. But besides commodities, and not all commodities, some did very well, if you were assuming you were investing in them to go up. Commodities went down this year, but pretty much most stocks went up. Bonds, for the most part, were okay. I mean, they didn't have a stellar year, but they were okay. And very little went down. Now, when you have a year like that, everyone's a hero. Everyone looks good. Everyone feels good. However, next year might not be the same. Next year, we're going to talk about our predictions next week. So tune in next week for our predictions event. But I want everyone to take this to heart, because when you have good years, that's not what defines your character. It's easy to have character in good years, right? It's easy to look good in good years. It's easy to be number one when the stakes are low or when times are easy. Greatness is defined by what happens when times are tough. Right? We all talk about in 2008 the hedge fund managers that did really well, that made lots of money because they were shorting basically the housing market. They were shorting all the junk paper out there, the Michael Burrys of the world, the people in the movie The Big Short. All of that is defined because times are terrible and everyone lost money, except for these guys. They didn't. And they were defined as being great. Now, were they great in other years? I don't know. But were they lucky in 2008? Maybe. But that's not the point. The point is they did really well and everyone talks about them, because that was one of the toughest times I've seen in my career, where not many people came out unscathed. So if you did well in that period, you were great. Now, many of those managers, I will point out, did very poorly for many, many years after. But that one year, when times were the worst, they did really well. So once again, I would, and to reflect Jensen Hung's sentiments, I wish you all ample doses of pain and suffering in 2025. I hope that you all find some character, because while 2025 might be another great year, we are due for a very rough patch in the next year or two, some of which we're going to go through today. But we'll get into our predictions next week, because I think it's going to be a more important thing. So why don't I'm going to go through a few of these, and then I'm going to do some reflection here, and Doug and I, we can kind of go back and forth on some charts. So I want to point something out, that there was a really interesting point that somebody made, which is Chairman Powell and his team raised interest rates 11 times between 2022 and 23. They've cut rates 3 times in 24, 50 basis points September, 25 in November, 25 in December. This is the first time in history that 100 basis points in Fed rate cuts have seen 100 basis point increase in the 10-year yield. So, to put this bluntly, the Fed lowered rates by 1%, and the 10-year went up 1%. So the 10-year decided the Fed is wrong, and I find that very interesting. Now, this individual points out that what makes it different? Well, $36 trillion in government debt. Now, I'm going to make this point because it's probably, many of you probably are missing what I'm saying. The Federal Reserve determines short-term rates. And what they do is they use the Fed funds rate to determine short-term rates. They raise or lower the Fed funds rate, and pretty much everything else in the short-term rates will comply. So if the Fed decided to raise interest rates 100 basis points tomorrow, all short-term rates, including the 3-month, 6-month, probably even the 1 year, are going to go up, right? If the Fed raise rates, their other rates are going to go up. But the further out you go in the curve, the less impact the Fed has. So if the Fed raised interest rates 1%, the 10-year, the 30-year might not even move, might not even budge. The 10-year probably somewhat. But as you go out, it becomes less important. What determines the long term is the bond market. The bond market determines long-term rates. Now, here's the interesting part. The 10-year has generally been impacted by the Fed funds rate. So if the Fed lowers rates, the 10-year goes down, Fed funds rate goes up, the 10-year goes up, typically. But this is, according to what they've said, this is the first time in history that we've seen 100 basis points Fed cut leading to 100 basis points increase in the 10-year. That it's the opposite. It's basically what it's saying is the bond market thinks the Fed's wrong. Now, you all might remember my prediction this year is the Fed wouldn't move rates at all, or maybe once, right? I thought, well, maybe they'll do it once. And they did it once, and then he decided to do it 100 basis points, which to me was totally unnecessary. I think the market is way overvalued. It's highly priced, and I think that we'd be perfectly fine if they didn't lower rates at all. Now, they did, which brings in a little bit of tinfoil hat, which I won't put mine on today, but they did it right before the election. They came up with some reasons, and the reasons seemed plausible, and I'm not saying that there were bad reasons. But of course, they were based on government numbers, meaning the job market's soft. The job market numbers were showing a little softness, which I get. And I'm not saying the Fed made a bad decision. I wouldn't have done it. I didn't think we needed it. Other people were puzzled. But they did it, and they did it before the election, and they got away with it, and it is what it is. Now, the question is, if that's the case, if the market is deciding that the long end of the curve, it needs to keep rising, what's the Fed going to do? Well, what's eventually going to happen if the Fed keeps cutting is it's going to cause our formerly inverted yield curve to become more positively sloped and more normal, which, as you all know, means that leads to a bear market, that leads to a recession. Every single time that's happened, it has led to recession. I'm not sure if it will this time. I suspect it probably will. But we'll get into the predictions next week. So that is a interesting sign that you could point in and say, isn't that interesting? Right? It's not evidence of anything. It's just a data point you can put into your predictions. So, Doug, what are some things that you found interesting in the last week? Because I want to get back into one other point here, but I want to get to you right now. What are some things that you find interesting right now?
Well, I just kind of want to stay a little bit on the treasuries and what you were talking about. I think we're starting to see. I mean, usually the argument is don't fight the Fed. I think that the bonds are definitely saying that they're disagreeing with the Fed in this circumstance. I think the repo market, reverse repo, is certainly saying that as well. As bonds are struggling to continue to sell at a level that that's needed in order to to indicate that there is confidence in our economy. The debt, well documented. We've spoken about it. What I thought, a couple of things I thought was really interesting, and again, I'm not going to say. Again, we love our we love our charts. We love our chart crimes. I don't have a lot of data behind this one, but I saw a chart this past week that the mean age of parents at birth hit its lowest point. This was going back to like 1938. Hit its lowest point right around, ironically, 1971 to 73. It's hard to tell because it kind of skips from 1968 to 1978. So kind of right there in the middle. Both men and women, age of parents down, steadily rising since then. There's been almost no dip. So obviously, that means that the parents are waiting longer and longer to have kids for any number of reasons. Is it economy? Is it because they're working harder to try to be established? We know that there's more working parents, dual incomes than ever before. And obviously, there's been a lot of talk, if anybody hasn't been following this, about declining birth rates globally in many of developed countries. In many places, it's catastrophic, because if you watch anything about birth rates, you have to achieve a certain level of birth rate. Unless you're going to get it through immigration, you have to achieve a certain level of birth rate in your society in order to maintain to prevent population collapse. And again, this is not something that happens quickly; it happens over time. So right now, there's a number of documentation. I don't have a chart in front of me showing that a significant number of developed countries are under that line. So that's certainly, and Japan has been leading this for years. They've had an extremely aged population. They've defied a lot of they've actually defied a lot of rules around the age of population, the number, the birth rate, et cetera, and of course their debt to GDP, to still maintain some semblance of stability. But again, it's not something that can continue indefinitely. And if you take a look at again, I'm not saying this is completely correlated, or causative, but we've talked about the gap of productivity, hourly compensation. There's a chart that I have that looking at the Economic Policy Institute, going back to right around that same time, right around 1970. If you look at the line between net productivity and hourly compensation, they were pretty much overlapped until that divergence. And since then, hourly compensation is up 115% cumulative. Net productivity, though, is up 252%. And of course, we talk about inflation. People know that I'm involved with college planning. You look at where wages have grown, and compared to the cost of everything else, it's hard to keep up. The real wages of good producing workers versus major sector productivity, basically along the same line, that divergence. Very difficult. I don't know if I don't know if causative in correlation, against the correlation, but clearly we're not having as many kids. We're working harder, we're earning less. And again, speaking of the working less part of it, there's that data that's coming out there, continuing to look at. You talked about the jobs. We've seen more and more revisions of jobs that are, that have been. The job market has been, again, sorry, I'm struggling a little bit today, but the job market has been revised, and we've actually seen more indication of the job market being softer than anticipated, and times that we really haven't seen this level of job numbers restating and decline in jobs in other times that aren't necessarily recessionary. I think the other thing too is what we're starting to see is again, housing costs. I saw an announcement of something this week: 52% of newly constructed apartments. We keep saying, a lot of people said the housing issue and the pricing is a supply issue. If that's the case, this is very interesting. 52% of newly constructed apartments in Q2 of 2024 were rented within 3 months of completion. And this is again, this doesn't go back very long. This is the second lowest reading since 2020, although 2020 was, a well-known poor economy. It's 74% record, down 74% from 2021. So you're seeing that now there's more supply. We've got new constructed apartments. They're not renting out. And simultaneously, you're also looking at the cost of buying a home. 1981 and 2006 were the only other times that homes were this expensive. 1981 mortgage rates were 18%. We're not there. 2006, we were about to experience the biggest housing crash ever. So now, again, looking into 2025, you start to look at the cost of buying a home to median income. You start looking at rent being cheaper in many cases than the purchase of buying a home. But yet we've got these new apartments that are not renting out quickly. I saw something too. There was an 18% increase in homelessness last year. So we are starting to see. I think we're starting to see some strains, and some cracks there. And I think the yields are telling you this. So going back to kind of summarizing it, the bonds are telling you, it's like, look, the economy, yeah, the stock market keeps going up, it's rolling, things look good on a surface level. But when we start looking at things like the debt that we've been talking about for the past year or so, this that has really continued to skyrocket, not only for the government but on the household level. You're talking about, I think, continual issue of strain that people are experiencing, and you're starting to see some details in that. By the way, you did talk about commodities. I thought this was very interesting. There was a post that diamonds may be a girl's best friend, but they're your portfolio's worst nightmare. Obviously, diamonds they're a well manipulated version of commodities because of De Beers, but the prices have fallen to their lowest level this century. So again, if you are looking to propose, at least, weddings may have gotten more expensive, but at least the ring on her hand won't. Again, whether it's correlated or causative, I know there's more factory made diamonds now. So I think that certainly has some play there. But simultaneously, after 2020, we saw a spike in kind of the trading market, things like shoes and baseball cards and a lot of things. Well, watches, Rolex watch prices is at its lowest level since 2020. It's down 31% from its peak of 2022. So again, if you're seeing a correlation here, a lot of things, again, we talked about the bullwhip effect. We talked about coming out of 2020. A lot of things kind of rolled up into 2021, into 2022. But since then, there's a lot of data that we are slowly starting to see that, as we've talked about M2 money supply, we've seen a lot of things in the economy. We're starting to see, again, those are commodities, right? And whether you want to call it or not, what Rolex watch prices, diamonds, oil, things like that, all coming down significantly in value. Generally, that's going to mean that there's a lot less disposable income, that that people are just willing to throw on these things that are, that could, again, an indicator that they're just not, that people are tightening up a little bit. And last thing I'll say, U.S. existing home prices are set to close at 4.04 million in 2024. That's the worst year since 1995, even lower than the 2008 financial crisis. Home prices have jumped over 50% since 2020. I just saw a chart around the country where we're still seeing significant price increases in homes. Again, if they're not selling, how come they're going up? I talked about this, I think, over the last couple of weeks. Yeah, we might have a reduction in supply. We have a reduction in supply and a reduction in demand. Okay, so if both of those things go down, it doesn't mean that there's lots of homes selling. It just means that when someone is willing to make the transaction, they're on a limited supply, they're still going to be able to command, if you have a good quality product, a higher value, because you might have a limited supply of quality in a pool of limited supply. And there's a lot of homes out there that need a lot of work. You're still seeing the ones that are selling are increasing in the cost of the purchase, but we're not seeing enough of those transactions to necessarily indicate health in the market. So, by the way, last thing, I'll leave it to this. I've got to come back to it, but I thought this was interesting. We talk about the markets being really good. Maybe that's indication that the economy is really good. I actually posted something about that goes back to 1993 about intraday versus overnight trading. And what's very interesting is the performance of the cumulative returns of the S&P 500, Kirk, since right around, let's just say 1997-ish, 95, 97. Intraday and overnight were relatively the same. But since then, the cumulative returns are up over 1,000 versus only about 100 for overnight versus 150 for intraday. So just if you think the markets are efficient, we don't have 24/7 trading. So unfortunately, when you do most of your trading, to those listening, you're not getting the bulk of when most of that market movement occurs. So.
Well, for those of you who don't know, I mean, the futures index, the S&P index, does trade
all night.
24/6.
Yep.
Yeah, it's 24/6 or 24/5.5. But yeah, it does trade 24 hours a day during the week. And what's interesting is that we do have global markets and a lot of things happen at night. And frankly, you don't need it if you want to be a good investor, unless you're a day trader. I can tell you, I've traded futures before in the past, and it's frustrating because they keep you up. You're like, well, what's happening? What am I missing? It's only because you can trade. If you couldn't trade, it wouldn't be a big deal because you wouldn't worry about it. But as soon as you realize you can, you're like, oh my God, what's going on? I don't want to miss it. So not healthy. I highly don't recommend that.
No, and I'll add this, and this is something I think, there's a lot of independent traders out there, a lot of individuals that try to do it themselves. There's a lot of people that have advisors sitting in offices somewhere that are just, are wearing 77 different hats for the client and, trying to convince the client that they're the best at all of it. This is one of those examples where it's very difficult for someone to wear 77 different hats and be really good at any of it. I mean, when you start talking about things like futures trading, you talk about global trading, this is something where if you're going to really be able to understand the markets, it is imperative that you really consider getting the help professionally of someone that actually has the capability and resources to be able to track this at the level that it needs to be watched, especially with computerized trading, as things have gotten faster and faster and things can just switch on a dime. So yeah, that's, again, you're sitting there checking it, doing a little day trading, doing your thing, going off playing your kids. It's great. Like you said, to start this conversation, it's great when everything looks what is doing well. When everything's, markets are just rolling, you look at it, you're like, I'm a genius. It's when those things diverge that it becomes imperative that, you have the resources and capability to really understand how to ebb and flow as we go through different secular and cyclical cycles. And that is when, the experts and the ones that really have the ability to watch this stuff work out. And they've said this. I mean, Vanguard put this out years ago about what they call advisor alpha, and generally getting about 3% more overall than the average person. Goes into a number of different things, but behavioral finance, watching, making sure that you're making decisions that are based off of on fundamentals, less on emotion, that you're, being able to be disciplined, that you're also able to understand and take advantage of those things when they occur. When do you need that help the most? It's when things aren't easy. And that goes back to the beginning of what, you posted about Jason Hang.
All right. So, all right, let's get into some charts I wanted to share. And first, I'm going to share I don't know if any of you remember the name Bob Farrell, but so Bob Farrell used to work at Merrill Lynch. I don't know if he still does, but yeah, he launched his career. Bob Farrell's he started in 1957. And he has these things called the 10 rules for the stock market. So I thought it would be a good time to share it this time of year. It's always interesting to kind of go back to the basics and to review what works, what are some hard and fast rules. There's tons of rules out there, but I think Bob's are pretty good, and people always share them this time of year. And I believe this year we lost a good market historian, Art Cashin. I think it was this year. I can't remember if it was this year or last year. But Art Cashin was at Paine-Webber when I started. So I started at Paine-Webber in 1999. And Art Cashin was this old bellwether guy. People always used to listen to him talk on the floor of the exchange about what's going on. He knew everything. He was just like tried and true. Like everyone listened to Art Cashin. He wasn't about fluff. He wasn't about being sexy. He was just telling it how it was, and he did that for many, many, many years. And he was a legend. Everyone respected him, which in Wall Street says something. Held everybody's respect and was a good guy. So, I always like listening to the old timers because they've experienced more than most of us have. Although I'm getting into the age where I'm becoming an old timer because I've been around long enough.
I was going to say, nobody's following you because of the sex appeal. Are they, Kirk? Or is that kind of part of your following?
It might be Doug. I haven't polled my audience, but I'm pretty sure if they're following me for sex appeal, they're listening to the wrong show. Anyway, so I'm going to go through the 10 rules, and we can kind of talk through them afterwards. So rule number 1, markets tend to return to the mean over time. What that means is basically, there's a reversion to the mean is kind of how that works. So it can go in excess in one direction, it goes in excess in other direction, but they eventually return to the mean over time. Number 2, excess moves in one direction, which will lead to excess in the opposite direction. It's more of the same what I said for number 1. Number 3, there are no new eras. Excesses are never permanent. Those of you who've been around long enough know the term, this time is different. It never is. Number 4, exponentially rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. So a market that drops 50% does not just go sideways. It rebounds, right? A market that goes straight up doesn't correct by going sideways. Although a more gently rising bull market does. But just keep that in mind. That one's a little bit of a hit or miss, because technically some markets do correct by going sideways. So just something to keep in mind, but I wouldn't use it as a rule. The public buys, number 5, the public buys the most at the top and the least at the bottom. I think we should all know that's true. When you see everyone going all in, it's usually a time the party's over. And when no one's buying, when everyone's out of cash and no one's buying, that's the time it bottoms out. And those are actually things I look for when the markets bottom out, is like, when are people done? When are they no longer buying because they're out? And usually that's the sign that the flush of the system is over. The next one, number 6, fear and greed are stronger than long-term resolve. I think we all know emotions drive the market. Fear and greed are very powerful emotions, and they're things to understand about yourself, because most of us are driven by fear or greed. It's better to know which one you're driven by, and your resolve won't hold up in the face of these. Number 7, markets are strongest when they're broad and weakest when they're narrow to a handful of blue chip names, i.e. breadth is important. We're going to get back to this one in one of the charts I'm going to show. Number 8, bear markets have 3 stages: sharp down, reflexive rebound, and drawn out fundamental downtrend. Number 9, when all experts and forecasts agree, something else is going to happen. Number 10, bull markets are more fun than bear markets. Now, there are other people have their own rules. There are 10 rules, but I like these. And these are more technical in nature. But Bob Farrell started his career as a fundamental analyst and then moved over to the technical side because he realized that there's more to stock prices than just income statements and cash flow analysis. And he's right? You could be 100% accurate on the financials, but sentiment rules the day. Because if you were focused on financials, you would have missed Amazon, you would have missed Apple, you would have missed NVIDIA, you would have missed all these stocks, Tesla, you'd miss all these stocks and thousands of % return because you were focused on the fundamentals. Now, it doesn't mean that those people are wrong. It just means that emotions rule the day. And if people want to invest in the next shiny widget, they're going to do that. And they're going to keep dumping money. I mean, look at cryptocurrency. Cryptocurrency is up, I don't know what %, but it hit 100,000 a coin for Bitcoin recently. That's a long way from basically zero when it started. And so when you look at these these stocks, I mean, cryptocurrency doesn't make any sense. Logically, from a fundamental standpoint, it doesn't make any sense. Now, is it going to go to zero? No, that's not what I'm saying. I'm saying it's not bound by fundamental analysis, right? It's bound by something else that's driving the price. Same thing with some of these growth stocks. What's driving it is not the fundamental analysis, it's the future growth that people are guessing is going to happen. Well, it's just a guess, right? You don't know, right? You know what the fundamentals are, but you don't know what it's going to be in the future because a lot can happen. But that's how markets work, right? And so the point is he moved over to the technical side because fundamentals are a marker, but it's a marker for long-term success, but short-term, you can get blown up pretty easily because a lot can happen that affects fundamentals. For instance, 2008, everything was great until the market crashed, and then everything was horrible, right? Everything was great in the late 90s until the tech bubble popped, and then everything was horrible. The fundamentals still stunk, but they went up a lot, and then they went down. It took like 10 years for terrible fundamentals to get realized. Point being is you need to understand both. You need to understand fundamentals, and you need to understand technicals. And somebody came up with a term, quanta technofunda. I forget what it was. It was basically a combination term of the three. Quantitative being the basically just data points and looking for sifting through the data for trends and concepts. So when you're looking at fundamentals and when you're looking at technicals, use them both, right? Use the fundamentals to pick what you want. Use the technicals to pick when you buy it. That's how I do it. I find that they're both valuable because at the end of the day, you could be right about the fundamentals, but be completely, and the market sees something being wrong, and you have to take that into heart and know that somebody knows more than you. Because I
have a perfect example for you.
Yeah, go ahead.
If you were trying to follow the fundamentals of Fartcoin in November of 2024, you would have not wanted to invest in it. But if you're following the technicals, it's up 3,900% since November. So again, here's a perfect example. Fartcoin.
gotta love the potty humor. This is the time of year to do it. So
it's sad that it's not even potty humor. This is an existing meme coin, Kirk.
Oh, I know. I mean, they call them all shit coins. It's basically coins that are meaningless, but people are betting, basically gambling on the price movements. It's ridiculous. It's like the Hawk Tua coin that basically went through the floor as soon as it went out. I mean, you got all these coins. I mean, it's totally ridiculous, but people are gambling, and that's okay. I mean, that's what makes markets, right? People are gambling on stuff. You got the Doji coin, which is basically just a social coin. It has no value other than just a social community, which is in itself interesting that people are interested in it, but it doesn't have any practical purpose. So anyway, so I think the 10 rules are really important. Everyone should take that to heart. Think about it. Look through this time of year. Look through the kind of the historical rules of thumb just for guidance, right? Some of these things aren't necessarily going to hold water, but things like the market never goes forever in one direction, or things are never permanent. I always think of it as this time is different. Every time you hear this time is different, it isn't. We've had a great year this year, and certainly we'll get into next week. We'll get into some of the year-end stuff, valuations, things like that. But I think the thing to keep in mind is this year was a great year for the stock market. It was a great year for crypto. It was an average year for some other things. It was a great year for gold. There was some really good markets this year, and there was some very average and some subpar markets, but most markets were good, and everyone's feeling good. This is the time that you have to kind of check what where your guiding light is. Are you gambling? Because if you feel like, hey, I'm just holding till this thing goes to the moon, maybe you should kind of pull some profits off the table and reserve some cash. Warren Buffett's been reserving cash for the last few years. When you see next week, when we kind of start to go through some of the numbers, you realize that things are not in great shape. And you want to take a pause to reflect on this, because at some point, and I'm not saying it's going to be immediate, could be January 2nd or the week after, because I think January 2nd is going to, people probably won't be trading the end of this week, but probably Monday of next week. Things are different, right? People are doing tax loss selling right now. They're they're trimming up their portfolios January 2nd, 3rd, 4th, 5th, 6th, 7th, whatever. That then you start to see what next year is going to look like. So I highly, highly, highly recommend everybody go back, look at your portfolios, and just reflect on how much emotion you have played in. Is this based on logic, or are you just really excited because you did well this year? If it's based on excitement, go back to your rules. We don't talk about this enough. Anytime you invest, you have to. I would recommend everybody get a trading journal every time you invest. I've got mine. Every time you invest, pick the date you invested, why you did it, right? Come up with your thesis. Just write out a few sentences why you're doing this. And it could be as simple as it's going up and I'm gambling. Like it doesn't have to be it doesn't have to be for logical reasons, right? If you're a technical, it could be, well, it bounced off this, or I just feel good, or my cousin Tommy told me it was a great pick. Whatever it is, right? Write it down. You also want to write down what your exit strategy is. What's your exit strategy? Are you holding till it goes to the moon? Are you holding till it goes to zero? Like, what's your exit strategy, right? Bitcoin is, to the moon or zero, in my opinion. So for me, my thesis would be, if it's going to zero, that's okay. Or it's going to go up 20x. My thesis is going to go up 20x. And if that happens, now some people think it's going to go up 200x. If you listen to Michael Saylor, he thinks it'll be 200x. I think it's only 20x. So if it's only 20x, then my thesis is hold until it hits that. When it does, sell out, right? And then move on, right? Or it could go to zero. That's also a thesis. And if that happens, it'll probably happen really quickly. But you have to understand what your exit strategy is. When are you going to get out? Because forever is generally not an exit strategy. Forever feels good today when you look at, a tech stock and think it's going to go to the moon. But you know what? Tech stocks go in and out of favor. How many of the original tech stocks, the original 20 computer companies are still around? IBM. That's it. That's it. After that, there are other computer companies that came after that, but they all got gobbled up or went bankrupt or whatever. But virtually none of them are still around. So understand that forever is not really a good strategy. It might be if you're Warren Buffett, it might be if you're an insurance company, it might be if you're an endowment. But for individuals, we all have time frames, and maybe that is a strategy, and that's okay. But you need to understand why you're buying into something. What's your exit strategy? Why you're buying? And if that thesis changes, that might be your exit strategy. My thesis is it's going to grow at 20% a year. Maybe 1 year it drops 10%. Okay, that's my exit, right? And so you need to figure out what it is. There's no right or wrong way. You just come up with your own thesis and then follow it and consistently review your reasons for being in. So when things change, you say, hey, the thesis has changed. Maybe that's your reason to get out, right? So point being, do some reflection this time of year. I highly recommend. You've got 2 days left. You got today and tomorrow, and then we'll be into a new year. If you're doing any tax loss selling, if you're doing any sort of rebalancing, now's an interesting time to do that. If you want to balance out your taxes. Anyway, Doug, you wrap it up here, and then next week we'll go through all our valuation charts.
Yeah. So appreciate it. I just wanted to throw just for fun out there, because I think since it's going to be New Year's Eve tomorrow. We always love to talk. We always love to talk about chart climbs, and we've talked about this before. There's a website called Spurious Correlations out there that just shows you, again, as we always talk about, correlation versus causative. If you've been buying food lately, you're very aware of inflation. Egg prices are going back through the roof. Meat prices have been expensive forever. Well, turns out there is a very telling correlation between the annual U.S. household spending on meats, poultry, fish, and eggs, and the S&P Global's stock price. Actually, see some possible, accuracy to that one, obviously, because if you're spending a lot more, and U.S. households are spending a lot more, that's definitely going to have an impact on global S&P Global. But those two things are lockstep since 2002. So good news, as long as it turns out according to this chart, as long as you're going to continue to work 2-3 jobs to try to afford food in your house, you're going to be helping to drive the S&P Global stock price. Again, this is a spurious correlation, but also
it's a chart crime for those of you who don't know what that means.
It's a chart crime, yes. And here's another one for you. Since we started talking about NVIDIA to start today, and since New Year's is coming up, there is a correlation between Google searches for when is New Year's and NVIDIA's stock price. And it turns out it's actually, if you look at when Google searches for when is New Year's started to dip, so did the significant drop in NVIDIA stock price. So I don't know about you, Kirk. This might be a chart crime, but I believe it. I think the more, if you hold NVIDIA stock, you need to get out there on Google and start searching for when New Year's is.
Who the heck is searching for when is New Year's, Doug? That's what I want to know. I mean, seriously, who's searching for that? Like 5-year-olds? Like who doesn't know when New Year's is? I guess it depends what country you're in, but you should know these things. Come on, isn't it like, national pride? When's New Year's?
It's unbelievable. I mean, the only thing I can guess is like, what day of the week is it going to be? Like, you're trying to figure out, like, is it Wednesday? Is the weekend? Because I'm with you.
That makes sense.
That's just absolutely downright ridiculous. But again, if you search, you better get out on Google and start typing away if you have any care about your NVIDIA stock, because they clearly are tied together. So long story short, here's the thing. I hope you had a great New Year. I hope it's, a holiday and time with family, and I hope things really work out for you. And as you're looking into 2025, I hope you have some great plans and some great opportunity. Just want to say to everybody out there, as you know, I know things that, some people are obviously having, better financially than others. Some people out there are struggling, and but no matter where you are, you have questions and you're concerned about things. And obviously, if one of those things is college, that's the area that I specialize in. We talk about a lot. What is it? It's not just saving for college. It's implementing a variety of cost reduction strategies. A lot of people think, it's just picking a college, or, I've got to open a 529, just putting money away and saving. No, there's actually using tax strategies and other types of cost reduction strategies can help you to reduce the cost. It's incredibly important because this, along with your home, may be one of the greatest expenses you're going to incur. You're looking between $90,000 to $200,000 or more just for one child. And that's, every dollar you put towards that, it's not going to other things that you love or you need, like retirement. And so it's, as you would look for any major expenditure like a car or a home, again, you would want to look for cost reducing strategies for those areas. Again, the same philosophy should be applied to college costs. And if you are a high income or a high net worth family, listen, this is not just for middle income earners. The higher your income, the more important it will be for you to take effective college planning and look at ways in which you can pay for this. Because again, for many of those families, you're talking about paying for college with after-tax dollars, which can be, add an incredibly costly expense to the overall cost of paying for education. So again, you might have a kid in high school. You might have a kid that's younger than that. You might already have kids in college. But if you're looking to pay less and put more to the things that you want or need than just giving it away to schools, this is a really important thing to look at. And again, if you have questions, please reach out to us. You can reach me at mergentcollegeadvisors.com, and that's MERGENT collegeadvisors.com.
Great. Well, thanks for coming on, Doug, and thanks for your wisdom this year in 2024 as we wrap it up. Happy holidays, everyone. Happy New Year. Hopefully everyone's going to do something fun and interesting. And once again, hopefully everybody spends some time to reflect on the past year and what happened, and also on what you want in 2025. I'm looking forward to a great 2025. Hopefully everyone else here is as well. So happy New Year. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. Please subscribe and leave a comment while you're there. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead and a great year ahead. And remember, no one will care about your money like you do. So invest in your life.